In less than 15 hours, a bombshell will drop that will shock the nation and could send markets plunging. Stay tuned. Tonight's show is brought to you by Upexi. You can find them on the Nasdaq symbol UPXI, and they're building the next generation in crypto treasury model. Now, their stock is up since we last featured them, and my new trading system is indicating another big move is coming. This is one trade you don't want to miss out on. Stay tuned to their show or check out the pinned comment or description for more information. Now, let's turn to Bloomberg, where we find out why the nightmare scenario could soon be here. As stagflation playbook for the S&P 500 gets a fresh look before the CPI data drops, and this is probably the most important news piece that will hit this month, because right now, what do investors want? They want inflation down because they want the Fed to cut. What do consumers want? They want inflation down because they need some financial relief. What about small businesses? Well, their situation is dire. But the real risk here, my friends, and this is one I've been warning about, is we could get signs that stagflation is here, and we already know what that means. It means we're headed right into a recession, even worse, potentially, an all-out financial crisis. A combination of slowing economic growth and rising price pressures isn't investors' base case scenario just yet. And it's not that at all, because we already know that investors are hoping that consumers are going to absorb all these higher prices. They're going to keep spending, and that's going to fatten the margins of companies and send stock prices up. If you tack on a Fed rate cut, well, of course, the prevailing belief is that that injects liquidity into the financial system and sends stocks soaring. Of course, we know that's not how it works at all. But again, the real risk here is we're going to see signs of stagflation. Let's take a look at this chart of consumer price index in blue against continued unemployment claims in red. We're going to use continued claims as a sign of growth, because we already know when the economy slows down, companies lay people off. Let's take a look at what happens over the cycles, because we can go back to the 90s where we see inflation up and continued claims were up as well. And we see the same thing happen during the dot-com bubble and the global financial crisis. Now, this time everybody thinks it's different, because you can see inflation is trending down, and if it continues to fall, everybody believes that that is the mythical soft landing. The continued claims will reverse, and next thing you know, we're off to the races. The problem here is there's a lot of belief now that we could see inflation turn to the upside. The question is, will demand fall off fast enough? But nevertheless, the risks are still there. Even if inflation cools off, if the labor market unwinds, well, that is the stagflation scenario, because it doesn't matter if inflation cools off if people can't afford prices to begin with. And across Wall Street, uncertainty about a return to 1970-style stagflation, as economists and strategists concerned that the Fed will hold interest rates steady, eliminating a key catalyst for the stock market. Now, what was the issue for the markets back in the 70s? Well, they were largely flat for about a decade. And this is the problem. This is what investors don't want to see, because the real risk is it'll set up for a very large correction and even potentially a bear market if we go into a recession. But again, nobody thinks a recession is coming here. But when we start to look at the data, there is a high probability the Fed will cut next month. Let's take a look at why. Because the Fed cares about inflation, that is until the labor market unwinds. Here you can see the federal funds rate in blue against continued claims in red. And we can see every time that the labor market starts to unwind, what happens is the Fed cuts rates. Now, this is the first time in a long time that you can see the labor market is unwinding, and we only have a 50 basis point cut on the record here. But if we continue to see employers lay off, and remember, there's a lot of signs of this. We saw this in the manufacturing PMIs. We know people are losing their job at the manufacturing level. The non-farm pay report validated that. And what did we hear about the services sector recently? That companies are pulling job openings, and we know that's the first step into cutting hours and then cutting jobs. But let's take a look at what Bank of America had to say. And they're reiterating their call that the Fed will have to remain on hold for the balance of the year, even with weaker job numbers. And so one thing we're starting to hear now out of Wall Street is this fear that inflation is legitimately going to go higher. And we're going to take a look at why they believe that, but there's a major problem, because again, there's an impact this is going to have on businesses, particularly small businesses, not to mention consumers. And this is all going to backflow into the labor market, because if you lose the labor market, it doesn't matter if inflation goes up. We know throughout history it becomes transitory when people have no money to spend. As concerns build about the durability of the job market, many companies are exploring ways to limit the tariff pass-through to price-sensitive consumers. And that's what we've been hearing from company after company. We raise our prices, demand goes down. And that's the issue here. Businesses need to push on higher prices to the consumer, but the consumer is saying, look, I can't afford them. You can raise them, and I'll just cut my spending. Economists expect government figures on Friday to show a solid gain in July's retail sales as incentives have helped push consumers to spend. But again, all of this is just front-running the expectation that tariffs are going to drive prices higher. And we do know consumers still need to spend, but this notion that retail sales are going to hold up, and this is what investors want, what they think is going to happen, I don't believe it at all. Let's take a look at this next chart. We've got advanced retail sales adjusted for inflation in blue against average weekly hours of production of non-supervisory employees in red. And you can see a very clear relationship. As paychecks shrink, as people lose hours, they spend less in the real economy. And that drives us into the dot-com bubble, then the global financial crisis. And look what happened now. That big drop in retail sales there, that was all due to a drop in hours. And now what's everybody hoping for? That there's going to be this huge surge in retail sales. But in order for that to happen, there either has to be a huge expansion in credit, which we didn't see, or people have to have more money to spend. And when we look back at the chart, what do we see here? Hours worked went up a little bit, but what's the issue? Inflation went up even more. And that's the problem, because this is going to impact small businesses in a major way. They're hanging on by a shoestring here. The problem is, I'm going to make the case, they're going to be the first to lay off, and in droves. And small U.S. firms are paying Trump tariffs face a whopping $202 billion annual hit. And when you start to think about their ability to absorb this, well, if you've ever worked for or ever owned a small business, you already know there's absolutely no way most of these can handle it. Now, the big companies can, but let's take a look at what they're about to face. The U.S. Chamber of Commerce estimated this month that the country has about 236,000 small business importers, those with less than 500 employees. And the goods they bought abroad were worth about $868 billion in 2023. And based on estimates, the combined annual tariff hit to these companies is estimated to be $202 billion, or about $856,000 per firm. Think about that. How are they going to absorb that? Well, the answer is they can't. And that's the problem here, because again, you look at Wall Street, they think everyone's going to keep spending and drive stock prices higher, particularly if we get a Fed rate cut. But the real issue I'm worrying about, that's stagflation. This is when growth goes down. And why do we know growth is going to go down? Because if these small businesses try to push higher prices onto the consumers, what are they going to do? They're going to reject them. And through June, businesses in the U.S. absorbed more than half of the cost of Trump tariffs, with the rest picked up by foreign exporters and American consumers. In the coming months, the burden will shift away from importers, and the share shouldered by consumers will rise to 67%. Now, this is a problem because consumers can't afford higher prices. And we know as their paychecks continue to shrink relative to inflation, they're going to have to cut back on the discretionary side of their spend. We're seeing that in fast food restaurants. We're hearing that from airlines, and we're going to see this happen even more. And as that starts to take hold, what it means is there's going to be less demand for workers. As fewer people are earning money and spending in the real economy, inflation, well, it's going to go away. And here you can see the evidence that these small businesses have no choice. They're going to head right into survival mode. Let's take a look at this chart of corporate profits after tax against continued claims. And you can see very clearly when corporate profits go negative that you see businesses start to lay off. They can absorb it for a little bit, but then they have no choice. Again, it's all about survival. And we already know right now that corporate profits are likely to head lower. And that means, my friends, that continued claims are going to head higher. So as we go back and talk about the beginning of this, we mentioned stagflation was the risk. And what is that again? It's slowing growth, as evidenced by consumers not being able to afford prices today, let alone higher prices in the future, and the fact that the labor market's already starting to unwind. And small businesses especially are grappling with the ability to stay in business, is exactly what I've been saying. This from the National Retail Federation, and what they're suggesting is exactly what I've been warning about. The small businesses have not seen the demand and sales over the past few years. They've been taking hits at the margin repeatedly. They've done everything they can to try to stay in business, and now the final straw is coming. And you think about it from their perspective. They already know demand is going to go down because people can't afford higher prices. So what's their only choice? It's going to be to lay people off. The National Retail Federation and Hackett Associates produce a monthly outlook in their global port tracker that forecasts a sharp drop in U.S. imports starting in September. Now think back, what was the last time this happened? What did we hear from the Port of Los Angeles and Port of Long Beach? That workers would show up to work and they had no hours. And then what happened from there? It spread all across the local communities and then started to run up the supply chain. And now what are we seeing again at the manufacturing level? Jobs are already being cut. And as imports go, well, so too does the labor market. Let's take a look at this chart of imports of goods and services in blue against continued claims in red. And you can see as imports go down, claims go up. And you can see this happens every time we go right into a recession. And now what is the risk? We already know that imports are going to go down. And as imports go down, the demand for labor is going to go with it. So you can see all the signs are pointing that we're headed into stagflation. And that's the risk of the CPI report tomorrow, because if it goes up, well, then it is a sign of stagflation. But if it goes down, it could also be a sign that demand is going away. And we know either way, if demand goes down, inflation follows. And if inflation goes up and demand's weakening, well, watch out. This is the worst case scenario. But this hasn't stopped Citibank from announcing that they think stock prices are going higher. As Citi strategists raise S&P 500 target on resilient earnings, and all this is designed to do is to get more people to buy prices at the high. But meanwhile, someone else is selling, and selling everything in a major way, and that's hedge funds. As hedge funds short stocks at the fastest pace in 4 months as retail bid fades. Now keep in mind here, as stocks go higher and the economy slows down, investors have less money to keep buying. And remember, they can only buy so much. A dollar buys less as price goes higher. But this hasn't stopped retail, but at some point it's going to. And unlike hedge funds which focus their bearish bets on macro and ETFs, retail investors were a mirror image as they continue to favor ETFs over single stocks and buying in concentrated large caps, again, buying what is going up. And again, this is exactly what happens during a bubble, is people chase what is rising. And that's why you see a market get further concentrated, which is exactly what I was warning about on our Sunday show, is that more money piles into a small number of stocks and then eventually the economy goes out from underneath and the bubble is burst. And that's the risk that we could see in the CPI report tomorrow. Now, there's a whole other outcome here. We could face what's exactly happening in China's economy right now. China consumer inflation was unchanged amid anti-price war campaign. Now keep in mind, everybody wants inflation to come down until they realize if it does, it means demand could be going right alongside with it. Resilient demand for Chinese goods overseas has helped the economy hold up surprisingly well in the face of U.S. tariffs. But industrial profits are deteriorating as companies struggle to pass on rising costs to consumers given weak spending power and poor sentiment. And that's exactly the same two issues the U.S. economy faces right now, is demand is falling and sentiment or outlook is also going down. And this means there's less demand, less customers. So what you're seeing at the industrial level, at the manufacturing level in China, they're fighting for customers and driving prices down. It's a lose-lose situation. But there's clear evidence that this is exactly what's coming from America, because we already know demand is going to go down. Let's take a look at now the consumer price index, shown in blue, overlaid against average weekly hours of production and non-supervisory employees. And we already know as paychecks shrink, even if inflation were to go up, as we see cycle after cycle, that it means inflation is going to be transitory. This is exactly what's happening in China, my friends. So even if we see inflation tick up, it's not a major problem here, because what we're suggesting is that if demand continues to fall because paychecks continue to shrink, inflation is going to roll over. Either way, what we're facing here is stagflation, a situation where consumers can't afford higher prices because they can't afford prices where they're at now. And that's why tomorrow's CPI report is going to be such a bombshell. It's going to shock the nation, could send markets reeling, and it's going to leave policymakers completely baffled. But something we do think could head a whole lot higher, that is the stock for our sponsor of today's show, Upexi. Again, you can find them on the NASDAQ under symbol UPXI. And they're a forward-thinking public company building a treasury focused on Solana, a high-performance blockchain designed for mass adoption. With $331 million in SOL holdings and a $300 million market cap, Upexi trades at just 0.9x NAV, while peers trade at 1.5 to 2.5x. That's like buying dollars for 90 cents. And again, everything you need to know in the pinned comment and description below. Solana launched in 2020 offers ultra-fast, low-cost transactions with its proof-of-history technology, making it a leader in active addresses, daily transactions, and decentralized exchange volumes. Its robust ecosystem supports finance, gaming, AI, and more. And Upexi's strategy provides crypto exposure through a familiar equity structure, improving on MicroStrategy's playbook by aggressively acquiring Solana to capitalize on its growth and enhance shareholder value. Upexi recently acquired $100 million of discounted locked SOL tokens in August of 2024, added more in October of 2024, demonstrating its commitment to building a substantial Solana treasury at attractive valuations. Upexi's capital markets flywheel leverages large-scale accredited capital raises to acquire and hold Solana, aiming to maximize value while employing risk-prudent practices like native staking and validator diversity. With seasoned executives and a focus on operational excellence, Upexi bridges crypto and traditional finance, offering a compelling opportunity to participate in Solana's growth. And something we think is headed a whole lot higher, that is their stock. Let's take a look at this chart, because we featured them last week and its stock went up since then. And right now we're flagging a 200-day moving day cross and a Bravo 9. Both of those are buy signals, and the way we see this going is up into that supply zone around $10.21. And you can see very clearly it's holding that 6-month volume profile on rising momentum. And again, this is an extremely bullish setup in our book. For more information, visit upexi.com and see how they're positioned to capture value in the expanding crypto market with Solana at its core. And be sure to check them out on the NASDAQ under symbol UPXI. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.